This conference will now be recorded.
Hello, my name is Eugene, and I'm the Chief Investment Officer and Portfolio Manager at Signet Financial Management. And I would like to present to you today our update on the stock market. Please take a look at disclaimers and disclosures. And today we'll talk about US equities, where we stand from the size and style standpoint. We'll take a look at yield curve and short-term interest rate spreads. We'll talk about valuation spreads, where we are, multi-factor macro and micro sector forecasts. We'll take a look at micro factors and what was working and what was not so far this year. And we'll talk a little bit about our recent rebalancings, which we've conducted to our actively managed strategies and what worked and what didn't work in the portfolios. We'll also touch upon the particular changes we've made to strategical equity portfolio and strategic dividend equity portfolio, and I'll briefly go over a small cap strategy we have created and tactical thematical tilts. Coronavirus is still the front page news. Elections obviously starting to chime in. The coronavirus news become more and more positive in terms of multiple vaccines, remedies, medicines, which seem to be much more efficient. We know much more about the virus, so we think, again, environment right now still remains positive for the long-term investments in the US equities, but we have to stay selective. We want to keep our barbell approach and have representation and growth and value with GARP concentration. We're still in the recession, and the changes on the virus front can impact the markets in the short run. At Signet, we usually look at sizes and style dynamics, and this is the chart we always share with our customers and clients. And you can see that we're still fairly stretched in terms of growth outperforming value. And it's been going on for a while. And this year, the concentration, even in S&P 500, reached fairly significant levels, with S&P really being driven by very few large cap growth, mostly tech stocks. The same is depicted in the valuation spreads. We can see that the valuation spreads are at the moment are fairly stretched, and expensive companies are much more expensive than the cheap companies. And valuation spreads shows exactly the difference between how much more expensive companies are more expensive than the cheap ones. So still 2.5 almost deviations away from the norm. And small caps have been punished by the market due to the stay-at-home economy prevalent over going back to normal economy at the moment. And although even in the small cap index, there are not that many mom and pop shops which truly suffered from the shutdowns and the pandemic, we still see this very pronounced large cap outperformance. On the fixed income side and the macroeconomic side, the good news for the equity markets is the fact that even with Federal Reserve vowing to keep interest rates low for even if inflation perks up, we can see that the Federal Reserve really reins in on the short interest rates, but doesn't have as much of a power over long-term interest rates. And the yield curve, the difference between 10-year interest rate and a short-term 3 months interest rate, started perking up. And that's good news for the economy. That means the yield curve is steepening. And we know from the past, when the yield curve is steepening, that's a forward-looking indicator for the economy overall and the stock market in particular. So at Signet, we do conduct a fairly extensive multi-factor economic forecast, and we base our view on economic sectors based on the macro forecast and micro forecast, and we marry both forecasts up. So as you can see, on the positive side, we still believe communication services, consumers, discretionary and staples, industrials, and IT are gonna do really well in the foreseeable future. Financials, materials, real estate, over the next 12 months, gonna be kind of iffy, neutral, but energy and utilities, we perceive on the negative side. Healthcare, we think we can override our quant-based forecast just due to the fact that political pressure is not going to be as tough on healthcare during these pandemic times. So over the last 3 months, consumer discretionary, communications, industrials, and IT actually strengthened and improved their position, and energy became a little less attractive. So here we can take a look at the heat map, which represents our view and how it's been changing over the last 12 months. And you can see that consumer discretionary in particular becoming more and more stronger, and staples fairly stable, communications, industrials, and information technology. All those sectors look very strong. When we look at the macro, just when we look at the macro indicators like employment, inflation, GDP, personal savings rates, we can see that consumer discretionary is still very strong with communications, industrials, and IT, but we see that staples kind of drop out, and the rest of the sectors really do not stand out. On the micro level, when we actually look at the bottom up, when we aggregate information on individual firms, publicly traded companies, and we roll them up into economic sectors, we see that there are more sectors which we could look favorably upon, probably because of the valuation being favorable. And again, consumers look pretty good. IT, industrial information technology, and materials and real estate actually look attractive at the moment. So again, we are favoring right now barbell approach, where we in the portfolios we have representatives of the which do really well in the stay-at-home economy, but we also think when the vaccine comes, the go back to normal companies will perk up as well. Again, a lot of unknowns in terms of whether virus is going to come back, whether we're going to have a second wave. So we have to be cautious about that. And but from the early signs, we see that global economy is going through a recovery in the second half of this year. At Signet, not only will look at the macro, micro factors on the aggregate approach, we also look at the micro scores, which really take into account the groupings of companies by different factors and how they score in our major 6-factor multi-factor framework. So we'll look at valuations, yield, And yield includes free cash flow yield, dividend yield, etc. We look at growth, earnings growth, sales growth, profitability growth, momentum, how well the companies are doing against the broader market over 12-month periods, shorter term periods, profitability, how profitable the companies are, and safety, how safe those companies, the dispersion of returns, the movements, betas of the world, etc. So you can see that usually the multi-factor framework works in the way that multiple factor groups support each other. But there is obviously, you can see that this year, especially after the pandemic erupted, pretty much valuation didn't work, and profitability and safety was kind of turned off, and really growth and some momentum really chimed in, and that kind of resonates very well with what we discussed early in terms of very few firms, large cap growers, FANGs of the world, do really well and did really well during the pandemic, while the broader market really underperformed. Actually, S&P 500, equally weighted S&P 500, underperforms its market cap version by almost 11% year to date so far. Let's talk about at Signet. We have several actively managed equity portfolios, and we use our multi-factor framework to compose them and rebalance them. And this polar chart represents actually the where we stand in the portfolio in comparison to the benchmark, and that's the circle in the middle, and against all the good scoring companies in our investable universe. So you can see that the factors which do work in the long run, we have a very good positioning in the strategical equity portfolio. So what worked so far year to date in the portfolio and what didn't? Communication services, obviously because of people staying at home and streaming and using internet more actively, worked really well. Energy, we underweighted in energy, so it did work really well for us. Industrials, materials, and utilities also being underweighted. Consumer discretionary, again, with Amazon pretty much dominating, and some home improvement stocks dominating the environment. It's very hard to really do really well unless you have like 6-7% in concentrated one theme of the portfolio. So consumer discretionary, we fell a little short. Same with staples. Financials, we had a couple positions with consumer credit, which but financials, just overall the sector fell the victim of the pandemic and the fact that Federal Reserve really keeps and going to keep interest rates very low. Healthcare, again, we did actually really well overall, but in terms of the comparison to the broader economic sector, we fell just slightly short. Information technology, again, some of the more of the hardware positions as well as the consulting positions, and one stock in particular, which had a good exposure to traveling, really underperformed. So we underperformed in information technology, but we made some changes to improve things in that regard. And real estate, again, some of the exposure we've fixed and changed year to date so far, but we again had some, office, commercial office space, which didn't do well, and probably not going to do well for a while with people working from home more and more. So what changed? in strategical equity portfolio is we kept mid-cap tilt a little bit to capitalize on the economy coming back with the virus being overthrown by a vaccine and existing medicines. So we tilt towards value just a little bit to capitalize on that, and we still increase GARP holdings as well, and we keep our barbell approach that I talked about. In sectors, we're beefing up consumer discretionary, IT with some semi exposure, and trimming industrials because we did phenomenal in some home improvement stocks, and closing gap in healthcare with an insurer. So this is the sector composition of our strategical equity portfolio, and you can see that we have very healthy IT representations, healthcare, industrials, consumer discretionary, and communication representation, but overall the portfolio is very well diversified. I talked about the small tilt towards value, but a whole bunch of value stocks we have a GARPer look and feel. So we are pretty much at balance right now between value and growth. Our second largest actively managed strategy is strategic dividend equity portfolio. This portfolio is designed to produce dividend income, and hence it has a value tilt, mostly large caps. And we made some changes, adding consumer discretionary, healthcare, keeping financials adequate, and bumping IT in this portfolio. This portfolio, again, is very well diversified. And in comparison to other dividend yielding strategies, we think we have a very nice information technology exposure alongside with healthcare, financials, and industrials, and consumers as well. Mostly, again, large cap value because of this dividend yield theme, but still have a very nice and healthy representation of large cap growth. At Signet, we never stop looking for promising areas, themes. We have our very sophisticated economic and factor analysis, our framework, proprietary framework. And a few years ago, we started a small cap portfolio. And I already, in my previous presentations, touched upon the strategic small cap portfolio and why we believe it's important after such a long time of small caps underperforming to gain that exposure in your portfolios, be it through ETFs or really standalone positions. We do have our portfolio we've composed with between 120 to 200 positions, depending on rebalancing, with really fundamentally strong companies and rebalance semi-annually. And we have a lot of features which we think can benefit our clients on the portfolio. Very well, again, diversified from the sector size and style standpoint. The other area where we took a tactical tilt approach, where we have a lot of clients with our either equity exposure or equity and bond exposure, and we try to be a little more tactical in those portfolios. And one particular tactical addition we've implemented is the thematic investing. This pandemic really exacerbated the trends which have been in works for a long time on the technology front with Internet of Things and many other things in healthcare. So we actually add exposure to our portfolios and allocations on the technology front, which cover a whole bunch of very acute topics everybody talks about, like artificial intelligence, Internet of Things, cybersecurity, digital payments. And on the healthcare side, we add a tactical exposure with population changing, pandemic made it real clear that healthcare needs to be accounted for, with longer people living longer, with genomics becoming much more important, immunology, medical devices, and actually telemedicine proving to be very resilient and working great during this pandemic time. So those two promising areas were added to allocations and could be added to your portfolio as well. We will have a standalone presentation on small cap, and we have actually added a mid cap strategy as well to the mix. So we'll have a standalone presentation on that, and also on the thematical tilts. Stay tuned, stay safe, and hopefully I will talk to you very soon. Goodbye.